Stock to flow is a way to assess the hardness of an asset. Stock to flow is a model that measures the scarcity of an asset by dividing its existing amount, i.e. the stock, by its annual new production, the flow. So it helps assess the hardness of an asset, meaning how difficult it is to produce the new supply compared to existing supplies. And why this is important is for a good to maintain its value, it is necessary that the supply of that good not increase too drastically during the period in which the owner wants to hold it. And history has shown us that whenever an asset can be rapidly produced, it loses its overall value. Historically, money was not invented by the state. It was a natural consequence of a commodity that had monetary characteristics that over time became selected by the free market. And they were selected to perform the function of money. This is how, for example, gold became money. The primary reason gold became money is because it had a high stock to flow ratio. It was hard to produce. And that hard to produce meant that the supply of the existing gold didn't grow drastically over time, which then equaled a good store of value for people that held that commodity over time. Anything used as a store of value will have its supply increased. So if you think about that, when gold has value, and so there's an incentive for people to go and mine more gold to increase the supply in exchange for the value that gold commands. Fast forward to today, where money is now just pieces of paper and digits on a screen and are not tied to commodities that are hard to produce like gold, meaning that it's very easy for governments to produce more of that money. The problem with government money is that its hardness depends entirely on those in charge to not inflate the supply. History has shown that all governments will always find a way to print. Let me give you a visual representation of what the stock to flow ratio looks like. This is a visual representation of what a high stock to flow and a low stock to flow ratio looks like. So the element in orange has a high stock to flow ratio, meaning that the existing stock of that asset compared to the amount that can be newly created within a given time frame, usually over a year period, that relationship between those two is what equates to a high stock to flow ratio, meaning you have a high stock versus the flow that can be newly created within a year's time frame. If you look at something with a low stock to flow ratio, like the elements in green, i.e. fiat currency, you have the existing stock of an asset compared to the amount that can be newly created within a given time frame. So if you think about gold is difficult to extract from the earth, and it's difficult to increase the supply rapidly compared to the existing supply. Whereas fiat currency, i.e. pieces of paper or digits on a screen, these can be increased rapidly within a short amount of time because they are not hard to produce. So why this matters is if something is scarce, it's way more likely to hold its value compared to if we can rapidly increase the supply of that item.